Hi guys, G-Economics here, and today I'm going to bring you an update with regard to what we have been looking at in the most recent playlist and the most up-to-date series, which is of course our consideration of wider reading and reading around the subject, reading beyond the syllabus in that respect. So here I have the literature which I'm currently reading. I've shown you this before, so this is the Joseph Stiglitz book entitled The Euro and Its Threat to the Future of Europe. In my first video I gave you a little bit of a summary of the preface to the book, and now I'd like to give you a little bit of a summary with regard to Chapter 1. Chapter 1, indeed all of the chapters in this book, they are quite long, so I may foreshorten what I'm going to say and maybe break this down into two parts. So here we go, here's a little bit of a resume of what is being discussed and talked about in Chapter 1. So Stiglitz sort of goes back to basics here in Chapter 1 and starts to identify the characteristics of the countries who were using the euro in 2007, of course, when the financial crisis broke. So he says the following. He says that countries using the euro in 2007 have experienced a period of economic stagnation from the period 2007 through to 2015. That is characterized by, in many of the Eurozone countries, double-digit unemployment, youth unemployment, particularly badly hit in some countries where 1 in 5, so 20% of young people your age no doubt, are unemployed. Low growth, low living standards, and indeed because of the deep stagnation within the economies, those living standards, those low living standards, could last for years and years and years to come. And then of course there's the whole notion which we touched upon previously with regard to the political vacuum which is built up, and so questions are arising politically with regard to the rise of far-right groups and so on. Again, something that we mentioned in the preface. So Stiglitz argues this. Stiglitz says that the central problem is the creation of a single currency without the creation of political institutions to make it work in such a diverse Europe. And indeed he argues, and he states that he believes that this whole notion of the Eurozone project has been quote-unquote flawed at birth, and then goes on to cite a few reasons why he considers this to be an unreasonable path to take. So the first reason is this: a single interest rate. Those of you who study economics at GCSE and A-level, you'll know that the European Central Bank is the bank which is responsible for setting the monetary policy and hence the base rate across those Eurozone member states. And Stiglitz argues that that is highly inflexible. And of course you can understand, I'm sure, why that is highly inflexible if you consider an economy in the booming north of the Eurozone, so let's consider Germany, and in the south we've got Greece, poles apart. So the German economy doing quite well, they could probably do with the lifting of the base rate. Why? In order to bring aggregate demand under control and to stave off any potential threat of inflation. Then consider in the south, Portugal, Greece and so on. These economies which are not doing well, they need a boost, they need a kickstart. And one of those kickstarts can come from monetary policy by lowering monetary policy. But of course, when you have all 19 member nations of the Eurozone and one interest rate, one base rate, then you're not able, it's not possible to have 19 separate interest rates for the 19 different economies. And so this is a very inflexible system which is running within the Eurozone. Secondly, there's a fixed exchange rate. Normally, in the case of the UK, and it's a great example of this, ever since we came out of the exchange rate mechanism in the 1990s, the UK's currency has floated, so it's moved upwards and downwards with market forces. By market forces we mean demand and supply. Well, in the Eurozone, where there is one fixed exchange rate, in Germany for example, one would anticipate normally under a floating system that the exchange rate would appreciate as the German economy does relatively well compared to the other Eurozone nations. That appreciation in its currency would help to increase export prices, help to reduce demand, and again stave off a little bit of inflationary pressure. In Greece, an economy which is struggling, if it had its own exchange rate, the value of that currency would drop off. That in turn would reduce the price of exports, which would in turn improve the competitiveness of the Greek exports and the Greek economy, and consequently that might help to boost Greek exports, leading to growth and so on, employment. But when you have a fixed exchange rate system, that cannot happen. So Stiglitz would argue that this is very inflexible and not very adaptable either. Power has been centralised with the European Central Bank since 1998, so that the whole monetary policy, the exchange rate and so on, very tight. The other problem is fiscal policy. So if you wish to get out of a recession, as the Greeks may well do, how do you do that? Well, the way in which one would do that would be to engage in some type of deficit spending, budget deficit spending. Year 11, we're just talking about this at the moment. That, of course, is an expansionary fiscal policy whereby you increase government spending, you reduce taxation. So, in effect, there is more money being pumped into the economy than you're receiving in revenue. So you're having to borrow. Well, in order to finance those borrowings, that will then obviously lead to successive budget deficits, which will add to the national debt. Now, as members of the Eurozone, countries who are members, there are very strict limits placed upon the amount of money that those countries can borrow. And so a country like Greece, that wants to get its economy growing, it is very much constrained by this thing called the Stability and Growth Pact. And that Stability and Growth Pact limits the extent to which the economy can borrow and engage in an expansionary fiscal policy. Stiglitz would argue that the European Central Bank should not simply be targeting inflation, but they should have a wider eye on growth, employment, stability, all of these things, whereas really its key focus has always been on inflation, which is entirely the opposite if you think about what the Bank of England does, for example. They certainly have a much wider outlook, as does the Federal Reserve under the auspices of Janet Yellen in the United States. And indeed, thinking about the United States, a lot of spending goes on at the federal level. So the federal government in the United States, they in turn, they pump in a lot of money. So 20% approximately of the federal budget, 20% of GDP is spent by the federal government in America, whereas in the European Union it's only 1% of its GDP. So Stiglitz would argue that there are very urgent structural reforms required. So I'm just going to stop it at that, ladies and gentlemen, with regard to these very significant fiscal constraints and monetary policy constraints. We'll leave it at that, and I'll come back with another little excerpt just with regard to chapter 1 at the moment. It's a very, very interesting book. I must say I'm really enjoying reading it, and I hope maybe it's giving you a little bit of an incentive to maybe get to Amazon and purchase a little copy for yourselves.